Welcome to the deep dive. We're uh, jumping straight into some pretty interesting financial shifts today.
Yeah,
We'll
definitely.
be looking closely at international trade, but also what's happening closer to home in Malaysian banking.
Right. And we're drawing heavily from a recent analysis from Tanazaran on YouTube. Some really good points in there.
Absolutely. So from that, we've kind of identified three main things to focus on.
hmm First up, there's this new U.S.-UK trade agreement, the first formal one.
Okay.
Then Bank Negara Malaysia's move on the statutory reserve requirement, the SRR. A bit of a surprise there.
Right. Wasn't expecting that one.
And finally, Public Bank's dividend news increasing the payout ratio, which kind of leads into a wider look at, dividend trends across Malaysian banks generally.
Got it. So our mission, as always, is to help you make sense of all this, get the key insights without hopefully feeling too overwhelmed.
Exactly.
Okay, so let's start with that U.S.-UK trade agreement. Feels like a pretty big deal right now.
It is, yeah. I mean, it was formally signed around May 9th based on the video's timeline.
Okay.
And what's really noteworthy is this is the first agreement like this the U.S. has signed since those Trump tariff proposals back in April.
Right. The timing is significant then.
Definitely tells a story.
And how does this play into the bigger U.S.-China situation? There was some chatter about tariffs there, too.
Well, there's been speculation, hasn't there, about the U.S. maybe having tariffs on Chinese goods down to 50% or something.
Yeah, heard that.
So one perspective is that getting this UK deal done, it sort of gives the U.S. a win, maybe takes some pressure off, gives them a bit more breathing room in the China talks.
Interesting angle. Like they've secured something so they can maybe afford to be a bit more flexible elsewhere?
Potentially, yeah. It might ease some of the tension in the financial markets, too.
Okay, so let's drill down into the agreement itself. What are the kind of the headlines? What did each side get or give up?
Well, based on the summary shown, it looks like the U.S. is keeping its current tariffs on U.K. imports. They're not changing those.
Okay, so status quo for the U.S. imports from the U.K.
Right. But the UK, on the other hand, they've agreed to cut their tariffs on U.S. goods quite a bit,
Oh,
down from 5.1% to 1.8%, and generally allowing more U.S. goods in.
wow. That's quite a difference. Seems a bit one-sided on the surface.
It does seem asymmetric, yeah. Could be the U.S. leveraging its market size, perhaps.
Makes sense. And what's the upside for the U.S. predicted to be in dollar terms?
The analysis mentioned potential gains around $61 billion in external revenue and maybe $51 billion in new export opportunities.
Significant numbers.
Definitely. And there's also this talk of forming a kind of trade union just for steel and aluminum between them.
A trade union, what does that imply? Like deeper cooperation?
Probably, yeah. Maybe shared standards, preferential access, that sort of thing, just for those specific metals.
Gotcha. Any other specific areas highlighted?
Yes. Pharmaceuticals. Enhanced cooperation on supply chain security, which is, very relevant now.
Understandable.
But the big winner mentioned really seems to be the UK auto industry.
Oh, yeah. How so?
Well, U.S. tariffs on UK cars are apparently dropping from 25% down to 0.
Zero. That's huge.
Massive. Could really boost sales for UK brands in the U.S. Think Jaguar, Land Rover.
Absolutely. And you mentioned aircraft parts, too.
Aircraft components, yeah. Also expected to see more trade there.
Okay. Now, bringing this back home, how does this affect Malaysia's own trade talks with the U.S.?
Well, that's the key question, isn't it? According to a high-ranking official, Ravi Jerser, who is apparently in Washington negotiating,
Yeah.
it's pretty unlikely Malaysia will get better terms than the UK did.
That sounds realistic, given the U.S.-UK relationship.
Exactly. So the expectation is, well, probably that a 10% blanket tariff for Malaysia might stick.
So negotiations are more about getting down from the original 24% towards that 10%?
Precisely. Trying to land somewhere in that range between 10% and 24%. Getting near the UK's 1.8% average seems, let's say, improbable. It highlights the different dynamics.
Right, different negotiating positions entirely. Okay, understood. Let's shift gears then. Bank Negara Malaysia, the central bank, they held the main interest rate.
Yep, the OPR stayed put.
But they did something else, the SRR. That was the surprise.
It was. They cut the statutory reserve requirement, the SRR, from 2% down to 1%.
And 1% is low.
The lowest it's been in 14 years. That's quite something.
14 years. Wow. So what does that actually do? What's the immediate effect?
It injects liquidity. The estimate is around RM 19 billion freed up within the financial system.
RM 19 billion. Okay, that's a lot of cash suddenly available to banks.
It is.
So why now? What's the thinking behind it, according to the analysis? Is it stimulus?
The interpretation is that it's more like a cushion, a precautionary step
A cushion against what?
against potential fallout from these trade uncertainties, the tariffs we were just talking about. It gives banks more liquidity, more breathing room, maybe to handle slower loan repayments if businesses get hit.
So it's not really about stimulating the economy directly, like an interest rate cut would be. More about building resilience.
Exactly that. Preparing the system for potential bumps in the road rather than hitting the accelerator.
Does B&M think things are going to get bad? Are they predicting a recession?
No, they've acknowledged the downside risks to growth, but they're not forecasting a recession currently. They do think the growth rate could be affected, though. A lot depends on how those U.S. trade talks pan out for Malaysia.
Right, it all ties together. Okay, just quickly, for anyone listening, how does the SRR actually work, the mechanics?
Sure. So basically, commercial banks like Bank, public bank, they have to keep a certain percentage of the money people deposit with them as reserves, held at the central bank, B&M.
Okay.
That used to be 2%. Now it's only 1%. So that extra 1% of deposits is now freed up. They don't have to keep it parked at B&M.
And they can lend that out instead.
Primarily, yes. Or use it for other banking operations. It just increases the funds they have available to deploy.
Got it. Makes sense why that injects liquidity. Okay, final piece. Public bank in dividends.
Right. Big news there. The CEO announced they're aiming to increase the dividend payout ratio to 60% in 2025.
60%. And they also said no share buybacks, right?
That's right. Focusing purely on dividends, it seems.
So for an investor, why is a higher payout ratio a big deal? What's the significance?
Well, it simply means a bigger slice of the profits, the after-tax profits, gets paid out directly to shareholders.
Okay.
So if you're an investor looking for income, that makes the stock potentially more attractive. And often, the market sees that positively. It can help the stock's valuation.
Right, but the actual amount, the ringgit and sen per share, that still depends on how much profit they actually make in 2025.
Absolutely. The 60% is a ratio. If profits go up compared to 2024, then yes, the actual dividend amount could be higher too. If profits fall, even at 60%, the dividend could be lower. It's tied to earnings.
Makes sense. The analysis mentioned public bank stock price has been doing well.
Yeah, it's recovered quite strongly, apparently getting close to its historical high.
So this dividend news could be another boost.
Could be, yeah. It signals confidence from management, gives investors another reason to hold the stock. It could act as a catalyst for further growth.
And we'll get a hint about earnings soon.
Pretty soon. First quarter 2025 results are expected sometime in May. Investors will definitely be watching those numbers to see if that higher dividend potential looks solid.
Okay. Now, zooming out a bit, is public bank just doing its own thing here, or is this part of a bigger trend in Malaysian banking?
It seems to be part of a broader trend, actually. The analysis pointed out that payout ratios for the top 5 banks, Public Bank, Bank, CIMB, RHB, have generally been creeping upwards over the last 5 years.
Oh, interesting. So they're all becoming a bit more generous.
Seems that way. It suggests a sector-wide shift towards returning more profit to shareholders.
Can you give us a rough comparison? How do the others stack up against Public Bank's new 60% target?
Sure. So Public Bank historically was like 52%, then 54%, 55%, 57% over the last 5 years, now aiming for 60%.
Okay. Steady climb.
Bank historically was often much higher, sometimes hitting 80–90% payout ratios in the past. A bit lower recently, but still generally higher than Public Bank's history.
Right.
CIMB has really ramped up recently, 66% in 2023, 65% in 2024. Quite high.
Higher than Public Bank's target even now.
Exactly. And RHB has been consistently over 60% for the last 4 years. It's like they've been setting the pace, maybe.
And Bank, you said, was a bit more variable.
Yeah, Banks has fluctuated a bit more and been generally lower than, say, CIMB or RHB in the most recent periods.
So it sounds like maybe Public Bank is playing a bit of catch-up with this 60% target.
That's a good way to look at it. The analysis suggests this move could be partly about aligning with peers like RHB and CIMB, maybe even setting sights higher towards Bank's levels eventually.
And that competition could be good for shareholders.
Potentially, yes. If the market likes this more generous payout, it could help Public Bank's valuation. It was noted that CIMB's stronger stock performance over the last couple of years might be partly down to its higher payout ratio.
Fascinating stuff. Okay, so just to quickly recap our deep dive today.
Yeah, we looked at that US-UK trade deal, the first one post-Trump tariffs, its details, and the likely implications for Malaysia, probably meaning no super favorable terms there.
Right.
Then, Bank Negar's SRR cut that surprise move down to 1%, seen more as a liquidity buffer, a precaution against trade risks, than immediate stimulus.
Got it.
And finally, Public Bank boosting its dividend payout target to 60%, which seems to fit a wider trend of Malaysian banks returning more cash to shareholders, possibly sparking some competitive dynamics there.
Great summary. This really shows how these global trade winds, central bank moves, and even individual company decisions are all, interconnected. So for you, our listener, maybe a final thought to chew on. Considering all these pieces, the shifting trade policies, the central bank's careful maneuvers, the banks focusing more on dividends, how do you think these forces might weave together to create both opportunities and maybe some challenges for you as an investor and for the wider economy in the year ahead?
Mm-hmm. Something to think about how all these parts influence each other.
Exactly. Thanks for joining us for this deep dive.